Welcome to StockTok's deep dive into automatic data processing. This is one of the most recognizable names in payroll and human capital management software, a business that has processed paychecks for American workers for decades. At the time of recording, the stock is trading at 247, sitting notably below both its 52-week high of 329 and its 200-day moving average of 258. The RSI of 45.4 places it in neutral territory. The setup here is one of a stock in a technical downtrend, trading below long-term trend lines. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Automatic Data Processing is a global provider of payroll processing, human resources technology, and workforce management solutions. Its moat is deep. Once a company embeds its HR systems into automatic data processing's platform, switching is expensive and disruptive. The StockTok score comes in at 48 out of 100, a caution signal. Valuation scores 10 out of 20. Financial health 7 out of 20. Profitability 14 out of 20. Growth 9 out of 20. And smart money 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, automatic data processing trades at a trailing price-to-earnings ratio of 19.28 times. That is the price you pay per dollar of current earnings. For a software business with sticky recurring revenue, that is not egregious, but it is also not cheap. The forward price-to-earnings ratio drops to 16.75 times, which implies the street expects earnings to expand over the next 12 months. The PEG ratio, which adjusts the price-to-earnings multiple for growth, with a reading below 1 generally considered attractive, sits at 1.45, suggesting the valuation is modestly above what the growth rate alone would justify. The EV to EBITDA multiple, a measure of enterprise value relative to operating cash generation that strips out capital structure differences, is 12.63 times. In our view, the economic moat here is substantial. Switching costs are among the highest in the payroll industry, and management has demonstrated durable pricing power across economic cycles. The Guru Focus Value, an intrinsic value estimate based on historical multiples and projected growth, stands at 297 at the time of recording, implying a margin of safety of approximately 32%, meaning the stock appears to trade at a meaningful discount to that estimate. Wall Street analysts, at the time of recording, have a consensus mean price target of 261 across 15 analysts, with estimates ranging from 208 on the low end to 332 on the high end, and the consensus recommendation is hold. The next earnings report is due April 29th of 2026, with the street expecting earnings per share of approximately 3.30, a near-term catalyst worth monitoring. Market sentiment around automatic data processing, as of the creation of this video, leans neutral, with insufficient recent news flow to tilt the signal in either direction. Relative to software peers, which have historically commanded EV to EBITDA multiples well above 15 times, the current setup looks incrementally interesting to us from a valuation standpoint. Moving to financial strength, how solid is the foundation? The Piotrowski F-score, a 9-point checklist of profitability signals, leverage trends, and operating efficiency, comes in at 6 out of 9. A score between 6 and 9 is generally viewed as healthy, so this reading suggests the underlying business fundamentals are in reasonably good shape. However, the Altman Z-score, a quantitative model originally designed to estimate the probability of financial distress, where scores below 1.8 raise concern, registers at 1.56, placing automatic data processing technically in the distress zone. That said, this framework was originally calibrated for industrial companies and is widely understood to produce misleading readings for financial services and payroll processors that carry client float balances on their books. So we would apply significant caution before drawing hard conclusions from that single figure. The cash-to-debt ratio of 0.57 means the company holds less than $1 of cash for every dollar of debt, Not alarming for an investment-grade franchise of this size, but worth noting. Interest coverage of 12.44 times, meaning operating income, covers interest expense more than 12 times over, is comfortable. The current ratio of 1.03 is just barely above 1, indicating current assets modestly exceed current liabilities. Debt to equity stands at 0.68. In our view, this balance sheet reflects a capital-light, cash-generative business operating with moderate leverage, typical for large-cap payroll platforms. Next up, profitability. Is this business actually making money efficiently? We start with return on invested capital, the measure of how much after-tax operating profit the company generates for every dollar of capital deployed in the business. At 7.58%, this reading is positive but modest for a software business. For context, truly exceptional capital allocators in enterprise software tend to run return on invested capital well above 15%, so this warrants scrutiny. However, return on invested capital can be structurally compressed in businesses that run heavy client float balance sheets, which is the case here. Moving down the income statement. Gross margin, the percentage of revenue remaining after direct costs, stands at 46%, a solid reading for a technology-enabled services platform. Operating margin of 26% reflects strong operational leverage. That is the ability to grow earnings faster than revenue as fixed costs are spread across a larger base. Net margin of nearly 20% confirms that after interest and taxes, $1 in $5 of revenue flows to shareholders. Free cash flow margin of 19.73%, essentially the percentage of revenue converted into actual distributable cash, closely mirrors the net margin, which is a sign of high earnings quality and minimal discrepancy between reported profits and real cash generation. In our view, the profitability profile of automatic data processing is one of the more compelling aspects of this investment thesis. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years has averaged 7.6% per year. Extending the window to 5 years, the annualized growth rate rises to 8.8%. That slight acceleration over the longer window suggests the business was growing faster in earlier periods and has moderated somewhat more recently, a pattern worth watching. For a company operating in a mature, highly penetrated end market like U.S. payroll processing, high single-digit revenue growth is respectable, but it does not justify the multiple premiums that hypergrowth software peers command. Book value growth over the trailing 3 years has come in at 25.4% annualized, a figure that on the surface looks impressive, but deserves context. Book value, which represents shareholder equity on the balance sheet, can expand sharply when a company retains earnings or when accumulated other comprehensive income swings favorably. It does not always signal equivalent growth in the underlying earning power of the business. The dividend yield at the time of recording is 3.23%, a meaningful income component for a stock of this type. Automatic data processing has a long history of dividend growth, and that yield at current prices is a genuine cushion for patient investors. The dividend aristocrat status of this business is a key part of the total return case. In our view, growth here is steady and predictable, but not a catalyst for significant multiple expansion. Now let's talk smart money. What institutional capital is actually doing with this name? 11 top-tier gurus currently hold positions in automatic data processing, according to the data available at the time of recording. That is a meaningful signal of long-term institutional conviction, but the direction of recent activity tells a more nuanced story. Terry Smith of Fundsmith, one of the most respected quality growth investors in the world, known for holding concentrated positions in high-return businesses for very long periods, holds the stock as 6.28% of his portfolio, but has recently reduced his position by 3.1%. Jensen Investment Management holds it at 2.57% of their portfolio and has reduced by 31.44%. A significant trim. Poland Capital Management has reduced by 19.71%. Bill Nigren of the Oakmark Funds shows no change in positioning. The pattern that emerges is one of high-quality managers holding the name, but actively trimming rather than adding. That is a yellow flag in our framework. On the institutional side, more broadly, only 11% of 13F filers, the mandatory quarterly disclosures filed by institutional managers, are net buyers of the stock at the time of recording. A reading above 50% is typically associated with net bullish institutional flow, so 11% represents a notably weak buying signal. Insider ownership stands at 2.23%, which is low, meaning management owns very little of the company relative to its size. In the last 3 months, insiders have recorded 0 purchases and 5 sales. Insider selling alone is not necessarily bearish executive sell for many reasons, but the combination of 0 buys and 5 sells, alongside broad institutional reduction, is a pattern that warrants caution in our opinion. And finally, the verdict. Let's bring it all together. On valuation, the data suggests automatic data processing is trading at a meaningful discount to its guru-focused intrinsic value estimate, and the forward earnings multiple is more reasonable than the headline trailing multiple implies. The setup looks incrementally interesting to us from a price perspective. On financial strength, the balance sheet is functional rather than fortress grade, adequate interest coverage and manageable leverage. But the Altman Z-score reading is an anomaly that bears watching, even accounting for its structural limitations when applied to this type of business. On profitability, in our view, this is the clearest strength in the thesis. Gross margins near 50%, operating margins above 25%, and free cash flow conversion that closely tracks reported earnings all speak to a business with genuine and durable economic advantages. On growth, the trajectory is steady but decelerating, and the dividend yield provides a meaningful income floor that partially offsets the absence of a compelling growth re-rating catalyst. On smart money, the picture is mixed at best. Quality managers hold the name, but the recent pattern of trimming rather than adding, combined with weak institutional buying and no insider purchases, is a signal we would want to see improve before building conviction. Overall, based on what we see, the bear case rests on slowing growth and declining institutional sponsorship, while the bull case is anchored in a durable moat, strong cash generation, and an apparent valuation discount to intrinsic value. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on automatic data processing. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.